If you're one looking for a more tax-efficient way to invest into a stable fund that provides strong growth and an income, SCHD may be at the top of your list as it's one of the most popular dividend ETFs in the market. And in this video, I'm going to explain exactly what it is and how it compares to other alternatives. To get straight to it, let's first go over what is SCHD. Now, SCHD is short for the Schwab US Dividend Equity ETF that is managed by the company Charles Schwab, where the fund's goal is to track as closely as possible the total return of the Dow Jones US Dividend 100 index. And the reason for 100 being in the name is because SCHD contains 100 companies that you can get exposure to all within one purchase. In fact, the index specifically states that it is designed to measure the performance of high dividend yielding stocks in the US with a record of consistently paying dividends. But it's not like someone on the street or even a fund manager is the one picking 100 of these companies that go into this fund. There's actually strict requirements that companies must pass in order to be inside of SCHD. For starters, stocks in SCHD must pass an initial screening process where they must have a minimum of 10 consecutive years of dividend payments, a minimum float adjusted market cap of $500 million, and a minimum 3-month average daily volume traded of $2 million. As you can see after that, the companies are also ranked by 4 fundamental characteristics that include free cash flow to debt, return on equity, indicated annual dividend yield, and a 5-year dividend growth rate. Also know that the stocks that are inside of this fund are going to be weighted every single quarter, where no single stock can represent more than 4% of the index, and no sector can be more than 25% of the index. So knowing that, the top companies in the fund that make up the largest impact consist of companies you've probably heard of like Pfizer, BlackRock, Coca-Cola, or Lockheed Martin. And even looking further into SCHD, the top sectors include financials at roughly 18%, healthcare at roughly 16%, and consumer staples at 14%. So knowing that about SCHD, here is a breakdown between SCHD and its top competitors. To start it off, the first dividend fund to compare with SCHD is the uprising Fidelity high-dividend ETF with the ticker FDVV. This fund seeks to provide investment returns that correspond to the performance of the Fidelity High-Dividend Index, that is Fidelity's in-house index that they manage, where you can see below it specifically states it is designed to reflect the performance of stocks of large and mid-cap dividend-paying companies that are expected to continue to pay and grow their dividends. And so by investing into this fund, you are going to be exposed to 111 holdings where the top ones consist of companies like Nvidia, Apple, and Microsoft, each being around 5 to 6% of weight toward the fund, which if we add the top 10 holdings up, they make up roughly 30% of the entire fund. And looking even deeper, the top sector in the fund is infotech at 25%, and largely because of that, FDVV has a 39% overlap by weight with the S&P 500, specifically VOO. But when it comes to index funds, they are going to be passively managed, and for this one, this is going to have the highest expense ratio of all the ones I'm covering in this video, that is 0.16%. And just a quick note for those that don't know, these fees are going to be automatically taken out from your investments over time. It's not something that you're going to have to be paying separately. And then when we look into the actual dividends for FDVV, it currently has a 2.91% dividend yield over the past 12 months, where the growth for the dividends has actually declined 7.66% over the same period. So with FDVV roughly trading at around $50 per share, this means for every share that you own, you will get paid 48 cents every quarter, which is every 3 months. All in all, if you had $10,000 in the fund FDVV that earned a 2.91% annual dividend yield, if you held onto it for that entire year, whether you reinvest the dividends or take them as income, the total dividends that you would be able to earn would be $291. But something really important to know about dividends is that they can be taxed as qualified dividends, which means that they can be taxed in the long-term capital gains bracket, which is between 0, 15, and 20%. I'll mention more on this later with SCHD, but for the fund FDVV, understand that it was reported in 2023 that the qualified dividend income percentage came out to be 74%, which means the rest of that amount would be taxed as ordinary income. So when it comes to FDVV and all the other dividend funds that I'm mentioning throughout this video, instead of a fixed income security where you get paid 3, 4, 5% of a fixed rate and that is it, when it comes to dividend investing, you are able to earn an interest and have your investment appreciate in value, grow over time for you. This is why there's going to be more risk and volatility when it comes to actually investing in stocks, but there of course could be more reward. For example, FDVV over the past year grew 37.8%, which includes dividends being reinvested instead of taking them out as income, but over the past 3 years, the fund has grown 12.67%, and over the past 5, that was 14.31%. Those are great returns, but I also like looking at the 10-year performance to see how far back it can go and what kind of data it was able to show, but for this one, it's not been out long enough as it was created in 2016, and its worst year since then was down just over 4% as a whole. Now, FDVV may be one of the best competitors with SCHD, but understand that it only has a 15% overlap with SCHD, so if you're stuck on the two, having both isn't the worst option. It's completely a personal choice no matter what you decide on with your investments, but understand that if you were to get an investment like the S&P 500 like VOO and a total stock market fund like VTI, they have an 87% overlap with each other, so depending on your portfolio, you may want to just pick one, which I made an entire video on it. If you want to check it out after this video, I'll have it linked in the description below. But besides that, before mentioning any further, I'd like to thank the sponsor of this video, Moomoo, which is a free investing app where you can invest into stocks, ETFs, and even options on their platform. There are no trading commissions or contract fees on equities, plus you get access to an insane amount of data and news to help you advance your investing knowledge. With Moomoo, you can currently earn an 8.1% APY on your uninvested cash for a limited time as a new user that is also FDIC insured up to $1 million. The platform has all sorts of financial tools, whether that be dividends, historical earnings, or any sort of data that you can think of on the go. They also have a learning tab that you can scroll around to learn more about the market, where a good example here could be their guide to learning ETFs, where you can even learn about specific companies based on particular industries that you may be interested in. And if you are one looking to test things out, you can actually paper trade on their platform, which is pretty much a stock trading simulation where you can invest fake money to see how your investments would perform over time. Their mobile app also has many features that you can customize however you'd like to whatever suits you best, so after a few minutes of familiarizing yourself with the platform, trading should be a breeze. So to join the 24 million users that are already on Moomoo, click the link in the description below and get up to 15 free stocks when you make a qualified deposit. Thanks to Moomoo for supporting the channel, and the next alternative to discuss will be the iShares Core Dividend ETF with the ticker DIVB. Now this fund seeks to track the Morningstar US Dividend and Buyback Index that currently has 420 holdings, where the top ones consist of Texas Instrument, JP Morgan, ExxonMobil, and Verizon, which if we add up these top 10 companies, they make up roughly 28% of the entire fund, where the top sector here is Infotech at 22%, and then financials and industrials thereafter. On top of that, the fund also has a 29% overlap with the S&P 500 and a lower expense ratio being 0.05%. And when it comes to dividends, DIVB has a 2.58% dividend yield over the past 12 months, but has also declined its dividends by a rate of 5.3% over the same period. This means that with its current share price of roughly $48, that every quarter it pays out a 35-cent dividend. But for DIVB, the qualified dividend income percentage that was reported in 2023 was stated to be 97% rather than FDVV at 74%. Now then for this fund, DIVB has actually grown 33.77% over the past year. It has averaged 10.2% over the past 3 and averaged 14.2% over the past 5, which it only goes back to 2017. And since then, its worst year was down 10.5%. Now, there are many more dividend funds out there that you could choose from. Many range from paying less dividends but focus on more of the growth, and vice versa. But SCHD and these other options I'm mentioning, they are strong overall dividend paying companies that also have solid growth over time, which if you are interested to learn more about different index funds, I've created an entire cheat sheet that I think you'll find great value from, which I'll have linked in the description below. But knowing that about FDVV and DIVB, here is exactly why I believe SCHD is one of the easiest and best overall dividend funds to purchase if that is what you're interested in. As I mentioned, SCHD contains 100 strong dividend paying companies, but if we look at the top 10 holdings alone, they make up the largest amount compared to the other alternatives, being roughly 41% of the entire fund. But what's really unique about SCHD that makes it great for diversification is that the fund only has a 7% overlap with the S&P 500, for this case VOO. So if if you are one heavy on the S&P 500, which my guess is that it's the majority of you, if you want to diversify away from all the heavy tech stocks like Apple, Nvidia, Microsoft, then going with some of SCHD may be a solid approach. Also know that I'm not a financial advisor, but when it comes to the dividends with SCHD, it has paid a 3.61% yield over the past 12 months and has grown at a rate of 12.23%, which after its recent share split that I covered in a previous video, it's now at roughly $28 per share, which means every quarter you will earn 26 cents. Sounds like nothing, but let's just say that you had $10,000 invested into SCHD and it stayed at that rate throughout an entire year. That means that you would earn $361 in dividends. But something else that I really like about SCHD is that as of the year 2023, it has reported to pay a 100% qualified dividend income, which means you could potentially reap long-term capital gains with your dividends that could be taxed in the brackets of 0, 15, or 20%. Besides that, SCHD has a 0.06% expense ratio, which over time can definitely save a ton from fees, especially if we look at the actively managed funds. A simple example here would be the fund JPI that is actively managed, looking for strong income, and it has a 0.35% expense ratio and pays non-qualified dividends because of its underlying structure. A fund like this I typically recommend in a tax-advantaged account like the Roth IRA, because if you are getting a high dividend yield where this one currently pays an 8% of interest, depending on how much you're bringing in, if you're paying ordinary income or with the Roth at the eligible age of retirement where it's tax-free, the difference is going to be substantial. But back to SCHD, if we look over the past year, it has grown 27.1%. It has averaged 9.1% over the past 3, 13.1% over the past 5, and an 11.7% average over the past 10 years. So of the three main funds that I've discussed, SCHD is the only one with more than 10 years of historical data. And although the short-term results for the other funds have done slightly better, that could also be due to them having more exposure to tech stocks like Nvidia, so the choice between one or the other may come down to what type of stocks are inside of the fund. But because of the diversification that you get with SCHD, being able to get a strong dividend income and solid growth over time, which you could also reinvest the dividends, to me make it one of the best options that you could choose from if you are one looking to add stability to a portfolio. And on top of that, if we look at the worst year that it's had over the past 10 years, it was down only 5.5% when compared to the S&P 500 that was negative 18%. And although SCHD is my top choice as an overall option, don't forget that there are many other dividend funds that you could combine with SCHD in a defensive portfolio, such as FDVV, DIVB, DGRO, DGRW, VOO, VYM, and many others. The biggest thing I'll point out if you are one looking to build a defensive portfolio with dividend funds is to just watch the qualified dividends that you are able to earn, because if you get investments like JPI and JPQ, you may be in for a surprise when it comes to tax season. So if you are one interested in dividends, assuming you pick the right investments, the choice really comes down to how much of the dividends you want compared to growth along your investments and vice versa. For example, you could just get the S&P 500 VOO that pays a 1.23% dividend yield on a quarterly basis and has averaged a 13.3% annual return over the past 10 years, which includes dividends being reinvested. But even if you took the dividends as income from the S&P 500 based on that data, you would still have achieved a 12% growth rate over the past 10 years. Or if you were to go with a high earning ETF like JPI, which I personally would only use in a tax advantaged account, but you could earn an 8% dividend yield. But over the past 3 years, with its average annual return of 9.58%, if you took the dividends as income, your investment wouldn't even have been able to keep up with inflation. So depending on your position, you may want to go all growth and reinvest any sort of dividends with investments like the S&P 500, but other positions you may want to diversify with other investments and take a dividend income. It's completely up to you. But because of SCHD's high dividend income, reduced volatility, tax efficiency, and solid growth over time, especially if you reinvest the dividends, although the growth over time will not be as high as something like the S&P 500, if you are looking to diversify your investments, these are just a few of the main reasons why I believe SCHD would be a great foundation to a dividend defensive portfolio. With that said, if you are interested to learn more about dividends, index funds, and investing as a whole, I'll have relevant videos that I've created similar to this linked in the description below for you, which I think you'll greatly benefit from. Which while you're checking that out, I'll also leave my free learning guides that I created, which I think you'll find great value from, especially my index fund cheat sheet. And while you're at it, if you want to see exactly how I allocate each of my investments and other exclusive content, don't forget to check out the Patreon that I'll have linked in the description below. If you want to start investing on a new platform like Moomoo and other top investment investment platforms in the market. Don't forget to check out the links I have in the description below, which depending on the account that you sign up for, I may earn a commission for it, which is greatly appreciated. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.